Bloomberg is reporting near on $5 trillion of M&A volume last year, which is not far off being the biggest year in history.
Neil Millar is one of New Zealand's top M&A lawyers and a partner at MinterEllison. We had such a great conversation last year. We agreed to get together this year and discuss the state of M&A in New Zealand and around the world.
Over the course of last year, we saw lots and lots of deal timelines stretch out, and in some cases by more than months, years. I'm into year 3 of selling a business at the moment.
There is a pointed and particularly tricky thing which has changed in the M&A landscape in New Zealand.
So I've rarely seen so many deals that I've been engaged on then fall over. I just didn't see, as a young lawyer, any of this caution. And investment bankers are always pushing timetables. And I was just to roll my eyes. Why are we having to work all night? Because they all operated under this idea that time killed a deal.
Whether you're a business owner or an investor looking to sell or curious about the market, this podcast will offer amazing insight into someone who's been in more deal rooms than almost anyone can shake a stick at.
And so one thing I've learned as a M&A lawyer is
Neil Millar, welcome back. It's great to have you on the show again.
nice to be back. Thanks for having me.
We said a year ago, and it was pretty much that time frame that we released our first episode, that we'd come back around and revisit the state of M&A for 2025 and make some predictions for 2026.
Yeah.
And here we are. So it's followed through and happened.
It has, and as I recall, you made a big deal about the fact we were both wearing linen shirts that day, and here we are both wearing linen shirts again. So
Indeed. In my
meant
instance, I broke my wrist and cracked a couple of ribs on the weekend as I was pruning a tree, and the tree wasn't happy about it, so ejected me from it. So that's my addition for today's episode.
Yeah, well, yeah. I hope you get better soon, mate.
Thank you. You've got a new pocket square, I think.
Yes, I do, yes.
So Neil is partner for M&A at MinterEllison, one of the leading law firms in the country. And so you do an annual review on what has happened in M&A in New Zealand over the last 12 months. And that's just about to come out. It's in draft form. So great opportunity for us to have a conversation about it. So at a really super high level, what was 2025 like from an M&A standpoint?
Well, yeah, that's right. So the M&A forecast, we're in a 9th year. So we tried to look back for 12 months, and then importantly look forward and try and make some predictions about what's going to happen in the market over the following 12 months. And then we sort of do a bit of detail around some of the themes. So that as you say, is coming out next week. In terms of 2025, it was a very sort of interesting year. So globally, M&A activity really took off. So Bloomberg is reporting near on $5 trillion of M&A volume last year, which is not far off being the biggest year in history.
Wow.
Largely off the back of 67 of these mega deals, these sort of $10 billion US dollar type deals, but also an increase in these sort of buy and build type strategies. So that's a big story.
Can I just pause on that for a second? Because that may or may not create some kind of backdraft for New Zealand over time. But the scale of those deals, was it a smaller number by the sounds of very, very large deals that had that sway to get it over into the, approaching $5 trillion? Because that's an obscene amount.
Yeah, it's an obscene amount of money. I mean, that's what's pushed it over the edge, I think, these sort of 67 odd really, really big deals. But then, there is a huge volume of just normal sized deals sitting behind that as well.
Yes.
And like I said, these kind of buy and build strategies also starting to emerge in much bigger numbers as well. It's sort of your platform asset and bolting on acquisitions. So there's been a lot of that activity globally as well. So, but yes, that's sort of those big, huge deals. They really do skew those numbers. Yeah.
2 qualifying questions. We've been awaiting the grey tsunami of deals coming along for a number of years, which is baby boomers exiting their businesses. Is that something that anyone has kind of done the demographics on those deals and commented on?
So we've done it. I mean, I can talk a lot about that when we get onto the kind of New Zealand experience.
Right.
Not so sure about globally. And again, we're talking the sorts of numbers that get you up to the $5 trillion or more, your big corporate transactions, your big, huge tech deals. And so there's less of that kind of succession. But New Zealand has got a huge succession issue, and we've had it for years. And I can talk about that maybe when we get onto the New Zealand
Okay,
context.
great.
Yeah.
The second question
yeah.
about the global is that the artificial intelligence AI space has had a lot of deal doing going on
Yep.
in the last 12 months or so. So there's been a couple that have been over about $10 billion. So that's having an influence on the market by the sounds.
It is, in a really interesting way. And one of the themes that comes through for last year, and I think also for this year, is around distress and the difficulty that startups face at the moment in raising money. And part of the reason for that is this flight to the really big AI companies, which at the expense of investing in the smaller startup companies. People are chucking all their money into the big players, and that's what's creating these huge deals. But also a bit of a void of venture capital
Yes.
which I'm sure you're very aware of. And so that's an interesting theme as well that's
Yeah.
coming out. Yeah.
So back to that kind of high level international.
Yeah.
Is there anything else on that front?
So 5 trillion activity, why, I guess, bottoming out interest rates globally, weakening US dollar, a pro-business regulatory environment as a result of certain
People.
new appointments to run certain countries. So all that sort of creating this sort of incredible volume of deal activity. In the New Zealand kind of environment, I guess it was a bit different. We found it to be quite a tough year for deal making, especially in the early part of the year through to the middle of the year. And then it picked up quite a bit. I think we're always a little bit behind what's happening globally in New Zealand, being down at the end of the earth somewhere. And so towards the end of the year, running into Christmas, you'll find that most of the law firms, most of the deal advisory firms were pretty busy, and activity started to pick up again. But that theme for the year, if we just sort of take a 5-year view, right? Like 2020, we're coming out of COVID. There's an enormous injection of cash into the global system. 2020, 21, and a bit of 22, some of the biggest years we've ever seen for volume in New Zealand. Lots and lots of money being spent. I kind of feel like it went through the system once and then disappeared. But huge deal volume, lots, and in that environment, in the New Zealand context, where the vast majority of our businesses are privately owned. Private owners could see great prices being paid, high prices being paid. More and more businesses then came to market, more and more volume, plenty of appetite to buy. And then of course, as we know, in sort of 2022 through to 2024, markets sort of rapidly shifted. We had wars, we had supply chain shocks, we had all sorts of problems. And there was really quite a severe switch between a buyer-friendly environment, a seller-friendly environment and a buyer-friendly environment, quite violent really, in how quickly it changed. And the problem with that in a New Zealand context in terms of just activity is that most of our owners, they don't need to sell, right? Most New Zealand businesses have weathered the recent storms. They're just not trading as well as they used to trade. And so they can be patient. They would like to sell. In their heads, they'd like to retire. But in their minds, they're saying, well, most deals are essentially some sort of multiple of my trading. And if I'm trading down, I'm not going to get a great multiple. So what was happening was less deals were coming to market. Those that were generally needed to. And so deals became harder. There's more of a gap between buyer and seller expectations in terms of value. And through 22, 23, 24, that was a real problem. But then throughout the course of last year, that gap started to narrow. And so there were deals to be done. But we didn't have these big auction processes that with lots of interested bidders that gives you competitive tension and gives you speed,
Yes.
and urgency. We had one-on-ones. And with one-on-ones, there's a huge amount of deal risk because the longer it takes, the more cautious the buyer gets, the more due diligence gets done, the more problems emerge, the more chances there are for people to decide it's not actually, maybe let's not do this deal. So over the course of last year, we saw lots and lots of deal timelines stretch out. And in some cases, by more than months, years. I'm into year 3 of selling a business at the moment.
Wow.
We also saw a lot more fall over in 23, 24, and in the early part of 25. Deals just simply not proceeding. And to put that in context, as an M&A lawyer, as a rule of thumb, we're generally last on board for the deal. And generally, people start spending money on lawyers when they're pretty certain that the deal's going to happen, because, as I say, like Stella Artois, we're reassuringly expensive.
I say the same thing about myself, actually.
So, you really generally get a feeling that a deal's going to happen when the M&A lawyer is on board, and so I've rarely seen so many deals that I've been engaged on then fall over. So that was the first half of the year, and then as we.
Hi, it's Josh. Thanks for listening to the show. When founders talk about the dream exit, they're really talking about freedom. Freedom to choose how to use their time and to decide what comes next. As a client of JB Were in New Zealand, I know this is what sets them apart. They help entrepreneurs and leaders turn success into significance. A great exit isn't just about the commas in your bank account. It's about what those commas allow you to create. Two Commas is proudly partnered with JB Were, helping founders by putting their wealth to work for generations.
And then as we got into the run into Christmas, and global conditions had really picked up, we really started to see quite a lot more activity and a sort of more of a return to normality. So we did, and I might talk about it a bit later, Grant Thornton Advisors, which is the global Grant Thornton private equity backed, fascinating actually, platform, which is going around buying the local businesses, bought the New Zealand business in 3 months from start to finish, which is quite an aggressive timetable for a deal that size. And various other deals that we did during that period in really quite normal timeframes. So we're pretty optimistic about the year. In the end, so there's an outfit called Merger Market you might have come across, an aggregator that they track deal activity globally. So they'll tell you 160 deals happened last year
In New Zealand.
in New Zealand.
Of more than what kind of?
I think they have a $5 million EV type of a cutoff point.
Got it.
But don't hold me to that. And roughly the interesting stat there was roughly a third of them were domestic buyers, and 2/3, I think it's the exact number is 47 domestic and 113 international buyers.
Okay.
So there's definitely a theme there, and that tracks the idea that globally there was a pickup
In New Zealand.
delivery buyers coming in
Yeah.
to buy, which we're seeing more and more of.
Mm.
And that's a big theme for this year, we think.
So that the trends over the last few years are fascinating, and I'd just like to kind of endeavour to get a little more insight into why we've gone through this kind of slump, if you will, last year and 2024. So if we reflect upon the COVID era, we had quantitative easing, printing money. We had the lowest interest rate regime in New Zealand for 50 plus years. Globally, I think it was about the same. And there was a willingness from people to take risks and to borrow, and also raising money on the capital markets was pretty easy as well. And so the same was true of selling businesses as it was of raising money for startups. So it was this aberration because it didn't really match any period of history that we had before that, certainly of recent history that we could compare it to. And so then when we went into 24, 25, the easy assumption to make from the outside would be that those things had tightened up. People got less willing to spend money based on economic contraction, broadly speaking. And those two things are obviously cousins, directly correlated, because if you are spending less money, there's less money around. And so there's less deals to be done. And, it kind of becomes this self-fulfilling prophecy. The second is that I wonder, was there less appetite for writing of loans, for issuing of debt from the banks to do these big deals, or was it something different that I haven't asked about?
So debt's an interesting one. Let me just try and answer that in stages. I guess you're right. So I think it's correct to look at 2020, 2021 as you called it, an aberration in terms of the volume was massive then. So it was, and certainly in my career in New Zealand, and I've been working as an M&A lawyer in New Zealand for 23 years now. it would be by far and away the biggest volumes we've seen. So I don't think anyone involved in our industry in a serious way could have expected those kind of volumes to continue. So there was definitely part of the drop is just back to normal, right? But then I think the other part is there's just been so many global shocks on top of that return to normal that's pushed it down again. So wars in the early days, the supply chain problems, all of the, and then of course this in the last sort of 12, 24 months, this sort of uncertainty around what's happening in the US, and and just I think we are very proud of almost always getting our predictions wrong in the M&A forecast that we do, and it's almost like a badge of honor now. So we were predicting a cautious return to optimistic, like cautious around volumes last year. And then Mr. Trump decided to start tariffing the entire world, and everybody sat on their hands for another 6 months. So I think there's you've got yes, a bit of an aberration followed by a return to normal, but then it's kind of gone the other way in terms of just all these global influences that make a buyer just think twice, but also that have actually directly impacted the trading of New Zealand businesses. And as I said, I think just a bit earlier, it is important to remember that the vast majority of businesses in New Zealand are owned by owner-operator founders who have already got the beautiful house, the beach house, the nice car, and they're going skiing in the winter and to the islands in the summer. And they're trading down, but they're still trading.
Yeah.
And so, yes, you talked about a succession issue, and that's a fascinating discussion in itself, right? It's been around for 20 years, but they know in their hearts of hearts, most of them know they need to sell, but they're quite hard to get into the frame of mind of selling at the best of times. But when times are tough and they can just do the numbers, they're less willing to be sellers at that point, and they don't need to be, so they stay away, and that depressed the activity as well, I think.
Yeah. Unfortunately, the backdrop that also happened last year is that we had the highest number of liquidations in New Zealand for about the last 14 years, I think the number was. And it was 5,500. I think it was just a shade under 6,000 by the end of the year, which was double the year before, which was the highest for about the last 13 years or so. So we have had a lot of businesses that have gone to the wall, unfortunately.
And we actually, so we track that too. And we have, since 2020, every forecast we've done, we predicted distressed acquisition activity, which never happened. We predicted it in 2020, 21, 22, and then in 2024, we started saying we're not going to predict anymore because it's clearly not going to happen. And then, of course, it started to happen. But ironically, our insolvency experts, because we have an insolvency team at the firm, they tell me that they see this as a sign of the recovery, which is quite interesting, right? Because what they say is, we've had this period where everybody's been scrambling, at a doing business level, and now what we're seeing is the result of the winners and the losers. So there are survivors who have done the right things, who have targeted the right customers, who have done the right structural things within their business, and are coming out as winners. But that means that inevitably there are now the losers, and they've been hanging on, but it's come to the end of the line for them. So they'll tell you that we saw this in the GFC, that actually as the recovery started to happen is when the liquidations and the business started to fall over, which is kind of interesting to me.
Yeah.
Because it's a little bit counterintuitive.
Yeah. The other part of that is that the business confidence surveys, which the ANZ and I think the Chamber of Commerce released at the back end of last year, are also the highest level of confidence that we've seen coming into this year for the last 14 years. Yeah, absolutely. Economics is, it's kind of like, sports to some extent. It's such a confidence play because people feel better. They go out and they spend more, they raise debt, then they get themselves into the position of feeling uncomfortable over time because they've got too much debt and they've spent too much money. So they contract and then the economy goes into a contraction and we just, voila, we have the economic cycle. So I've oversimplified it, of course, but so do you have economists write your report on M&A activity, because they're famously always wrong? So
No. We actually, in the early days of our forecast, we used to have we do an event around it. We used to have economists come and tell us what they thought, and we do that from time to time. But no, we sort of stick to the nuts and bolts of the deals and the themes that are coming through in the deals. We don't try and pretend that we're economists. Yeah. Although we're just as successful as they are at predicting what's going to happen, which is not very successful.
Yeah.
But so there you go.
So of those 130,
160
deals, and 130 acquired by
113 international
Yes.
buyers, 47 domestic buyers.
Yeah, got it. Okay. Are there any themes that you can tell us about those deals that were done?
Yeah. So there's quite a few themes actually. So one is a relative absence of private equity over the last sort of 12 months, and there's various reasons for that. So the first reason, which we've already talked about, is private equity invests in privately owned businesses. Less privately owned businesses are coming to market. So as buyers, with actually most of our domestic and Australian private equity funds are pretty well funded right now in terms of committed capital. They just don't have, or they haven't had very good pipeline. Right. So, and then ironically, as sellers of businesses, private equities got the same problem everybody else has, right? So they're sitting on portfolio companies that are fundamentally good companies that are trading down. Not a good time to sell. Great thing about private equity is it can be patient, more reasonably patient, I should say. But as an investor in private equity, reasonably patient. But so they've been not as in the market as we would typically see, which means that actually most of the activity has been around trade buyers. And I guess one of the big themes of the last 12 months and probably the next 12 months are corporate carve-outs. So this is corporates divesting themselves of non-core assets, and probably the most obvious one is Fonterra divesting its consumer products division to Lactalis in a transaction that we were involved in that deal. Unfortunately, not for the winning bidder, which is just part of life. But Sparks data centers going to PEP. So there's been a lot of that activity, and PE much less so. So that's a key theme. And then back to those numbers, we've seen more and more American investors coming into the market, which has been interesting. So, and they come with a whole set of issues that the sellers need to get their head around, that are not new issues, but certainly difficult mindset type issues to reverse, because Americans do deals in a very different way from, well, basically the rest of us.
Interesting. My mind immediately goes to tax and guns. So they have both of those things.
They don't. We haven't seen many guns in the deals.
No, just
occasionally we've reached for one, but it wasn't there, unfortunately.
Indeed. So how does their behaviour differ?
So American deal doing is a much more buyer friendly oriented starting point. So I guess every jurisdiction has what you might refer to as market norms for the sort of key terms of a transaction. The New Zealand market norms are much more aligned with Australia, the UK type of deal principles, which is a more balanced approach to division of risk. For example, Americans, the starting point for their documents are much more skewed towards the buyer.
Okay.
So to get into a little bit of detail, we buy and sell companies with warranties, and Americans take a much more stringent approach to the way in which you can carve out liability for those warranties than a typical New Zealand deal would. And so that a few years ago, an American coming into this market, if I was acting for a sell side lawyer, I would be able to phone up the buy side lawyer and tell them, you're in New Zealand now, buddy, you're not in Kansas anymore.
Yeah.
This is how we do deals, and if you want to buy my client, you're going to do it on New Zealand paper.
Right.
Not really anymore. So now it's quite the opposite. The Americans come in and say, if you want me to buy your company, you're going to you're not just going to do it on New Zealand on US deal terms, but we're going to do it on an A5 bit of paper and New Times Roman.
Yeah, wow.
And in fact, the last deal we did with an American buyer was subject to Delaware law.
Which
It's
is,
entirely
for those that don't know, it's a state in the US where a lot of corporates are domiciled from a tax perspective, I think is the key reason.
much, yeah.
Yeah.
But the point being that an entirely New Zealand deal, a New Zealand company, a share deal, documented and subject to US law.
Wow.
Yeah.
Mm.
And so that and again, the interesting thing there for sellers that find themselves in that sort of predicament is the role of the advisors, because it would be very easy to be very alarmist about that, and we see it all the time. And for the wrong advisor to detonate an otherwise fantastic deal over a principle like that, the alternative view is to say, well, businesses change hands all day long in the US. As long as we understand the terms, and as long as our clients get their head around what the terms mean, if the deal is the right number, the job is to balance the risk. It's not. There's only one way to do a deal, right?
Yeah.
So we spend a lot of time managing these sorts of issues, because the legals should not get in the way of a good transaction.
Yeah, absolutely. Practically speaking, so if one was to do a deal based on the same terms that you've just described, so Delaware law, Times New Roman,
Yeah.
US deal terms, what would that mean? And that's a kind of collective question, but from a high level, what would that mean for a New Zealand seller versus selling to a local company or an Australian one, for example?
Well, I mean, 9 times out of 10, it doesn't mean anything, right? If the number's right. Because the best way that a seller protects themselves because what a document is about is the aftermath of a deal, right?
Yeah.
Well, it's a roadmap to when I get paid.
Yes.
Which is just nuts and bolts stuff. And in an American deal, there's a few more painful nuts and bolts that need to be on the table, but it's just paperwork. It's just pushing paper around, right? So unfortunately, American deals cost more because lawyers have to produce, in my view, pointless bits of paper to get across the table. But that's just admin, right? That's no big deal. Most of a document's about the aftermath, right? And the best way to manage the aftermath, or to manage the risks around the aftermath of a deal, is to know your company. And most of our clients know their companies, because, of course, the protections that buyers are looking for is what is it that we don't know about that you're not telling us. So as long as we make sure that we understand what it is they'd like to know, which is essentially what warranties are all about, and tell them, then there is no problem. And the great thing about Kiwis is they, owner operators, is they know their businesses inside out. So again, it's about approach of an advisor, because I can tell you as a business owner with one hat on, well, these sets of warranties, and what that means is that there's 25 pages of statements, and if you've got any of them wrong, you're getting sued. Or I can say, this is about your business. And as long as we make sure you understand what these questions are, your business, we can help you answer these questions. Everything's going to be fine.
Yes.
Right. So it's about mindset. And,
right.
Again, US style deals are a bit more painful, a bit more admin, a little bit more exposure to risk. But if the number's right, then you shouldn't, in my view, pass that up over a smaller number with slightly more normal terms.
Yes.
Right. You just need a lawyer that understands and can explain to you what all of that means in a non-frightening way.
Yes. Subsequently, and this is a generic kind of question, so it calls for generalizing in its nature. But subsequent to the deal being done, the assets are handed over, the shares are handed over, if that's the same nature of that deal. What differences do you observe of how American acquirers behave after they've got control of the business versus, say, New Zealand acquirers?
Well, one of the great things about international buyers is that they're somewhere else. So, more often than not, and well, not just a US buyer, but an international buyer is buying a business, they expect to have a New Zealand-based management team, which is normally going to be the same management team that you had before, possibly yourself as a founder hanging in there for at least a period of time. And so, um, I guess each of these sort of, you can put these buyers into different categories, right? So investors, so private equity, so US or international private equity, Australian private equity, New Zealand private equity, that's a certain style of ownership, which involves backing the right people and then some level of governance, oversight, strategic input, right? And that varies from PE house to PE house, whether it's a US or a domestic or an Australian or a European private equity house. And the job there for a seller is to do your due diligence on their personalities, because there is no one size fits all when it comes to the style of a private equity house. And I don't know that I would say that there's much of a theme from country to country.
Right.
So we've dealt with US private equity funds that are fantastic, easy to deal with, want to just let the management team get on with it. We've dealt with domestic funds in the same boat. We've dealt with some real pricks on both sides of the ocean, right? So there's not much of a theme there. Then you've got corporates, and again, my experience of corporates is that can be a slightly harder transition post, because corporates, well, there's this age-old thing, and you'll know more about this than I do, but you're excited by some small, punchy New Zealand sort of business that's got a real corner of the market and a bit of a zeitgeist going on, and you think, want to capture that, bottle it for your organization, and you kill it dead culturally within 12 months of your acquisition. And we've seen some horror stories where the key person that wasn't in the ownership structure gets an email the day after completion saying, "You now report to me," and not even a phone call. And I expect my report by next Monday, sort of thing. And that there's so there's a bit of that happens. And again, I wouldn't say that's a particularly American, or I've seen that coming out of Australia, I've seen that coming out of New Zealand, I've seen that coming out of US. There is a theme where post deals where which is attitude to disputes, right? So and we often talk about the kind of the relative in jurisdictions, the relative litigiousness of countries. So obviously litigation in the US is just a business tool.
Yeah.
And in the UK you would bring shame on the family if you got involved in litigation. Australia and New Zealand are somewhere in the middle. We kind of talk about them being transatlantic in terms of their styles. So, New Zealanders are quite happy to have a big dust up over a point of principle.
Mm-hmm.
So there's a little bit around that, right? So Americans, if Americans think they've got rights post the deal, they will probably seek to enforce those rights.
Yeah.
Aussies and Kiwis buyers will. They prefer not to have formal litigation, but they will work pretty hard to sort of push a settlement that favors them. And so there's a little bit of that. There's a little bit of a difference there, but not a huge amount.
Yeah. We're at a point in time where the so-called golden visa is a bit of a thing, and has been for about 6-9 months or so in New Zealand. And so that's investing, I think, more than $5 million into New Zealand. And
it's changed up the rules a bit across a whole bunch of
yes, they have
parts of that.
Do you know if any of those deals from Americans are related to that objective?
So, I'm involved in one right now where there's an AIP investor that sits behind the buyer. They're smaller deals. It's a bit hit and miss, and actually, I think one of the relaxations of the rules is being able to put slightly less money now into the bonds again, which is going to push into more passive investing. That there was this idea for a while, as you know, where you could do direct investing and you had to write, but it felt a little bit like a needle in a haystack type territory, because you had to have some millionaire who's really, really interested in or really, really skillful at a certain area of business, who has to find just the right business to invest in, and so it felt a bit hit and miss. But there are definitely deals coming through. But it's not. Yeah, I mean, I guess we're seeing that. I think that's going to impact things like venture capital a bit more. Like startups, smaller transactions. I think there'll be a bit more of that as a result. But these slightly bigger exits for your sort of mid-market companies, not so much.
Yeah. There was talk post the aberration of 21, 22 and 2020 up to 2022 of there still remaining quite a lot of dry powder inside these acquisition firms. And if I'm correct, I picked up you saying that there was less PE activity than there has been historically.
There's still that powder.
Yeah. Okay. So do you think that, and you alluded to this earlier, that there's been this kind of focus from those firms on getting into AI kind of territory, if they haven't been already, and plowing some money into there, or are they still sitting on this dry powder and waiting to see where opportunities might land?
So in the New Zealand context, I guess, so the domestic funds, the Australian funds, have quite a lot of money still to invest. And it's a bit pent up because, of course, most Australasian PE funds have a committed capital model. So they don't have my money yet, but I've committed to it. So it's sitting in my bank account, not doing anything. So there's a certain expectation that you'll get, in a particular fund, you'll get all the money out within a certain period of time. And so when we have a 12, 24-month period where not much pipeline is coming through, or not as much pipeline is coming through, you get some pent-up demand there from private equity because they kind of need to get the money out, because it's sitting, like I say, it's sitting in my bank account. I want to start earning a return on it. Are they interested in AI? I think they are. I think really only the huge global private equity funds can be investing in, if you like, the fountain of AI, the big AI projects. But what the mid-market funds are all interested in is investing in good tech companies, and then especially if they can see that there's an AI or AI adjacent way to accelerate that company. So they're all interested in the AI strategy for that particular business or this particular business, and if that's going to be used. And it's no coincidence that if we talk about sectors, that for many years the sort of New Zealand technology sector has been one of the biggest performers in terms of activity, and we think will continue to be. So lots and lots of deals getting done in that space because New Zealanders are, they're innovators and technology driven, and lots of great companies are coming out. So PE is interested in AI. I think the domestic funds and the Australasian funds are not really able to invest in the big creators of AI, but they're certainly very interested in investing in businesses that can then use it or who are already using it.
Yeah. I have a theory that the foundational model providers, such as OpenAI or Anthropic with Claude, that have gone through processes of raising hundreds of billions of dollars in the last 12 months or so, I think that they are just so far ahead in that race of creating those large language models than anyone that has the lunacy to try and compete with those folk, unless they revolutionize something around how that is delivered. Then that stable doors open, the horses bolted. Then the next layer up, you've got the companies that are building upon those foundational models, such as, I don't know, Whisper, for example, which is a simple dictation AI software that I use, and many hundreds, in fact, thousands of others. I have a keen eye on there's an AI for that.com. Have you come across that?
No.
So they list, basically, it's a open source directory of all of the AI tools, and it was clicking up by the hundreds per week last year. So there's a whole lot of different companies. Now there's really, I think that for businesses that are looking to start not a foundational, but like a platform play, the next level up, that you have to be pretty clear about who's already operating in that space, because when you go looking, you'll find there's probably already 15 alternatives that have raised $50 million each. And so, can you really win and compete in that market? And so then people say, well, is it too late for us with AI? And I'm like, not at all, because I think the next level and where the opportunity really exists is smart services plays where you utilize the tools that are the best of breed from others and then bridge between the human and those tools so that the firms can pick them up and run with them effectively. I believe in that AI is really augmented intelligence, not artificial intelligence. It's obviously both of those things, but augmented meaning that the machine is able to work seamlessly in unison with the human, and those will be the firms that'll win. And so, getting better at that.
Right to me.
Yeah, that's where I think the opportunity is going to lie. Is there a kind of a specific deal that is in the public domain or something which was a kind of really interesting deal that you could give us some insight to from last year, Neil?
Sure. I mean, there's a couple. Things I can't really talk about. So we were involved in the Fonterra deal, but unfortunately for an underbidder. Probably the most interesting one I was involved in, which I've mentioned already, is this Grant Thornton deal, which is sort of an interesting global play. So Grant Thornton, the well-known accounting firm, is actually 160 businesses around the world,
Right.
each one separately owned, and then you have a company, I think it's based out of Switzerland, that owns some IP around the name and some systems and the rest of it, and so it's essentially sort of like a franchise model, but they're all individually owned. And about sort of 18 months ago, private equity got interested, and one in particular got up and running and bought the US, the whole US business. That's 950 accounting partners, and then got into a battle with another one and started and they started going around mopping up, and it looks like our client is one. So they're called Grant Thornton Advisors, and they have done 15, 16, 17 transactions in 12 months. They've bought various of the Grant Thorntons in Europe. They've bought Ireland. They've bought one or two in Asia, and they've now bought the New Zealand business. So that was to me a fascinating play on a fascinating insight into just this massive process globally to go around bolting. I mean, they're creating literally billions of dollars worth of revenue, just bolting on. The New Zealand business relative to that is quite a small transaction, but to get an insight into the process that's involved to be able to do that. We're feeding into a US law firm and a global M&A team, I think some of whom have possibly not slept for almost a year. It's just quite crazy to see the pace at which that transaction went, and the level of detail that we got into, whilst they were also managing 16 other deals at the same time. Crazy.
Mm-hmm.
Yeah, really interesting.
Accountancy practices, advisory practices are fascinating in that they actually carry a much greater multiple than the traditional professional services firms. Often they sit 1 times revenue and even can fetch above that.
I've got no comment about value, obviously, but
yeah, indeed.
But yeah, I mean, it's a fascinating business because, as a person is involved in a professional services firm, our model, it all relies on the pyramid and the reward that our great lawyers have is that one day they get to be an owner, right? And so the corporatization of that model is a really interesting concept. And how do you guarantee keeping those good people who have been programmed that one day ownership is the goal? How do you keep them in the seat? And they've got some really interesting novel ways of doing that, and I feel sure they'll be very successful. But it's a really interesting mindset change from that traditional model of come and work for us for a few years and then get promoted and then get promoted again, and then one day you have a seat at the table with us and you'll be a co-owner. And that's been a very successful model for many decades.
Yes.
And it's worked pretty well for me, so I'm a big fan of it.
Of course.
And I don't know how I'd feel if I was back to being 32 years old and someone said, "Oh, we've sold the company."
Yeah, you've got to work for the man again.
Yeah. I quick test of my own team. I told them, soon after we finished the deal, I said, "Oh, we've just so you know, we've just agreed to sell to them too." And just joking.
Resignation the next day.
Yeah, that's right. Yeah.
It's funny we're talking about that in the advisory space, the accountancy space. I've been working with a firm, a mid-sized New Zealand law firm, can't name, and they have been approached by a very large US global firm
Yeah.
that's in the broader advisory space that is looking to go through the same process. So they're looking to do a global roll-up. Can't name them either, unfortunately. I'm under an NDA. But they are similar kind of scale. I think they're about employee-wise 20,000 in the United States. So reasonably chunky firm, and their intention is to go on this global kind of roll-up of firms that are around the professional advisory space. And I scratched the surface of the deal terms, and I looked them in the eyes and I said, "This just does not stack up to me. You will have no control over this business, no ability to manage the cash allocations. You're going to be paid the first tranche in 3 years, and then another year after that, and another year after that. So you've got no money that comes back to you for that 3 years, which is obviously how they're going to fund the deal, take the profit out of your firm, and then pay that to you down the path." And a variable multiple. It was a dreadful deal.
Sounds like they need a good M&A lawyer.
Oh, they probably do. Yeah. Do you know what? But it was interesting that is something that is happening elsewhere in the space.
Yeah.
Any view on why that might be the case?
Well, I mean, I view these deals as multiple arbitrage. I can't see it working any other way really, because you have to look after. So you are telling a bunch of owners and the next layer down that it's worth their while to sell. So therefore, you have to be giving them at least as good an opportunity to make profit as they would have done if they just stayed as owners. And I think the obvious upside for your client, or the potential upside is, well, first of all, that profit that I'm eligible for might go up because as part of a global network, there'll be, on a per owner basis, more profit than if I'm just a local entity, right? Because one of the things that New Zealand, we're a pretty saturated market for professional services. And so, capacity is not our problem most of the time. It's getting the revenue in the door. And as you will be well aware, revenue, we have some really quite very, very different variances in profitability across, say, law firms. The cost base is quite similar for a lot of our firms, but you tuck in extra revenue, all of it goes to the bottom line. So if you're part of an international network and you get a 10% bump in referrals even, right? It's not like you're not going to have to hire anyone else. You're just going to be putting more in the top and pulling more at the bottom. So there's that. But then there's also, you still got to make sure as the new owner that these people are properly remunerated. So I guess my take on that is that you're banking on the fact that you're going to do that for a while, and then collectively everyone gets the big exit because you'll float it on NASDAQ, or and then Ma and Pa will pay 20 times for it or whatever.
That's the hope.
Yeah, because I don't think you can keep it going just on giving everybody that was a seller the same money that they always were expecting to get, because what's for you?
Yeah.
What's left for you? And if you don't give them, they'll leave.
Yes.
So, yeah.
So more deals were getting stilted, stalled, and killed than historically?
Yeah, over the last sort of 18 months.
Yeah. Key reasons for that?
Well, as I said, so what what tends to happen, right, is if you look at it, so let's compare it with 2021, say, right? So the height of the market, lots and lots of money chasing deals. There's some fantastic deal advisors in this country. You're for sale. You're a good business. You're trading well. You hire an advisor. They create a really good, pressured, time-bound process. You got to get your MBIO in by this date. We'll take 3 through. No, we're not giving anybody exclusivity. you have to get your final offers in by this date. Okay, you're the preferred bidder. You've got 2 weeks to get this deal agreed with us. This is Neil. He's our lawyer. Late nights, bang, 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 deal gets done, right? Because if you don't comply with our timetable, we're going to number 2, or we're going to number 3, or we're going to number 4. Versus, well, there ain't that much buyers out there. There's not that much interest. We've got a one-on-one. It's a corporate. We're talking, and we're talking, and we're talking, and we're talking, and all the guy in my organization that needs to be the decision makers on holiday right now, but we'll come back to you in 2 weeks' time. And can you just give us a bit more information here? So that first bit before you even get to the advisors is just kicking the can down the road, because you're interested. You're a mid-level executive in a large corporate, and you're interested in this acquisition, but there's no hurry. And let's just see how the next couple of weeks plays out, and the next month plays out, and the next month. So that's the first bit, and then we get into the deal, and now more people in your organization are involved, and the in-house lawyer is going, oh, well, it feels a bit risky, and the board's not so sure, so, well, we'll do this deal, but we're going to have to knock another 5 million off it to do this deal, or we'll do this deal, but we really need to be absolutely risk-free on this issue or that issue. So now we've got deal terms that are hard to swallow. So now we're negotiating. So now the negotiation takes longer, and it's just, I grew up as a lawyer through sort of from sort of post.com bubble through to GFC, where prior to that, just deals got done and done and done and done, and I just didn't see as a young lawyer any of this caution. And investment bankers are always pushing timetables, and I was just to roll my eyes. Why are we having to work all night? Because they all operated under this idea that time killed a deal.
Yeah, right.
And now I understand.
Yes, it does.
At the young age of 53, I can understand, right? Like it does. There's just an algorithm that says the longer that we take to get this done, the more chance there is that someone is going to back out, put pause, have a problem, get locked on an issue, lose interest, something shinier will come along. All these different things happen. So it's just that whole age-old thing, without that competitive pressure.
Yeah.
So if I was a seller, and I was in this environment, and I was looking for advisors in that kind of not my area, the deal advisor space, I'd be very focused on what their idea of a process is. One I've been involved in, I think I mentioned we're into year 3 on.
Yes.
I didn't know the offshore advisors were appointed. Never heard of them. They seem like they really know the industry. They seem like they really know the business. But I have not seen the competitive tension, and they've allowed first one corporate to just spin the wheels of our client for best part of 8 months before losing interest. And then they allowed another to spin the wheels for 8 months and then lose interest.
Yeah, wow.
And then what's happened is we've finally wrestled the deal into the hands of a committed buyer. And guess what? We've got process and a process letter and a timetable and exclusivity that's going to run out if you don't get this deal done by a certain date. And suddenly we've got traction.
I'm astounded the vendor is still at the table after 3 years, but it's interesting. A whole number of things go through my mind there. So it comes down to the impetus to do the deal to a certain extent. James McCarthy from Spidertracks and I had a conversation quite early on the life of this podcast, actually. And when he was going through the sale process, it was to a relatively newly formed PE firm. And despite being relatively newly formed, they had millions of dollars that they'd raised and a commitment to go out and buy X number of companies. And so he clocked quite early on in the process that these guys are in the business of doing acquisitions. So they are here to buy companies. And so if they don't buy a company, then they're missing one of their key raison d'etres, and their metrics and their measures will not happen.
Yeah.
And so they've got people in this instance of where they're turning up to, kick around a deal. Maybe they intend to do the deal. Maybe they don't intend to do the deal. But the reason that companies are bought in the first place is that the buyer, the purchaser, believes that they can extract some value from that company, and the aggregated consequence of those two things coming together is that they are greater than the sum of the individual parts, right?
Yeah.
That's the belief. And so, yes, it's been a difficult economic environment, but if you don't do the deal, you can't extract the value. You can't turn your company into what you want to turn it into. In my book, I talk a lot about some incredible deals that have happened over time. The more famous ones that people will be aware of is YouTube's influence on the value of Google today. They bought it for $1.2 billion about 10, 12 years ago, which at the time was an astounding sum of money. And now they reckon it's worth about $300 to $400 billion worth of Google's couple of $1 trillion, depending on which day you look at the stock price. And so, phenomenal deals. And yes, they've done some absolute clangers along the way as well. They bought Motorola for $12.5 billion and then sold it 2 years later for $3 billion. So they wrote down $9.5 billion, just keeping some of the patents along the way. That was by far and away their biggest clanger. But others they've done have been, absolutely stellar successes. And so it's all predicated upon doing a deal, right? And so are people, do you think, just kind of going, I'll preserve the capital, wait for better opportunities to come along, or are they kind of not meeting a key part of their remit, or is the risk has gone out of there, the appetite for risk has gone out, or is it too hard a question to answer on a aggregated basis?
Yeah, well, yeah. So there, that's a good. The last bit's quite interesting there, which is I am always a little bit nervous because we obviously we invite this because we do a forecast every year, so we're asked about themes, and it's sometimes quite hard to talk about themes in a New Zealand context, right? And because we're a pretty small country, so even 160 deals is not a huge data set, right? Like a few years ago, there were 2 pet food deals in 1 year, so it was a theme that pet food is hot. I don't know. Right?
2 deals, yeah.
So, what I guess part of the answer to that is the difference between corporates and private equity. So I agree. So private equity is in the business of doing deals, and as I said earlier, especially in this part of the world where they're committed capital funds, they kind of have to because they promise to spend your money, and you it's burning a hole in your bank account, not earning anything. So you want them to do it. So they have my experience of, in particular, the domestic private equity is they're very, very competent and they won't do a silly deal because they really respect your money, right? Which is really nice. They're not just going to chuck it out just for the sake of getting it out. But generally speaking, once they're in a process where they've got some commitment or some conviction about an asset, they want to buy it. They're not tire kickers, right? They won't buy it if what you told them at the start with your flyer and your fancy IM turns out to be bullshit, right? They won't buy it then, right? And that happens a lot, right? And that, because quite often, to be honest, to be perfectly blunt, quite often privately owned businesses don't even understand the problems they've got in their businesses, right? And when you chuck in a big tax partner or accounting partner to start going through things and they find the hole and they go, Jesus, did you not realize this? And they go, oh shit. Right. So there's a bit of that, but private equity, by and large, you're quite right. If you can get them interested in the asset, because quite often they won't be in the first place, if you can get them interested in the asset, when our private equity clients call us and say, we have just signed an NBIO to buy, then there's a very high conversion rate, I think, from that point to there being a deal.
Yeah.
Unless there's a problem that's discovered. And in fact, I'm just doing one right now. We've just had this conversation with a client. They're nervous. I said, look, we know this private equity fund. They're not going to play games, right? As long as what we've said is there, that's the number they're going to pay. They're not really interested in chipping people. They're not really interested. They've worked out their number. As long as their assumptions hold, they'll pay you that number. They want to do the deal. They have conviction. That's a good thing about them. Corporates is a bit different though, isn't it? Right. So corporates is these huge kind of, I mean, I look from the outside because I'm a creature of professional services firms. I've only ever worked in professional services, which is a very weird business structure. But corporates, in my view, are even weirder, right? They're just layer upon layer of bureaucracy and decision making and fiefdoms and all the rest of it. And so one thing I've learned as a M&A lawyer is, well, just because the head of blah 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 has told you that they really want to buy the business doesn't mean that the corporate at a DNA level wants to buy your business. It means he does, right? And so just that starting point, I think there's a lot more wobble.
Yeah.
So what happens is somebody wants to build the kingdom, and this new shiny thing is in his head going to really, make that happen. And so they start the discussion. I mean, I sort of lost count of the amount of times that someone said, "Oh, well, the head of this and the head of that was really interested, and we had a really good meeting with the head of this thing, but he's away for the next 3 weeks." And then, but it's when the rubber hits the road, it's quite often hard to pin down the point at which a corporate will actually commit to buying, because you quite often you can't even have visibility over who the decision maker will be at that point, how high up the organization you actually go, until you find someone who will actually say yes, and it will mean something.
Yeah.
So there's a little bit of that, I think, as well. And corporates are governed by boards. So it's just like, in the past, we're rubber stampers. By the time the thing got approved by the board, they just came in and said yes. But these days, of course, boards are very acutely aware of their obligations to
Risk.
to govern and to risk and all the rest of it. So we've seen deals where the business has been absolutely firing on all guns, and is absolutely committed to the deal. And then they say, "Oh, it's just this last bit of the process. We just didn't get the board approval," and the board's grilled them and said, "No. Why didn't you come to us earlier? Why didn't you?" So there's all sorts of dynamics that go on with those corporates, which I think you're right about private equity. They're in the business of buying businesses, and unless there's a good reason, they'll follow through. They might be hard to get into the process, but once they're in and they're committed, they'll follow through. But corporates is much harder, much more amorphous
Yes.
situation, I think. Yeah.
You mentioned the S word earlier on, succession.
Oh, yes.
Something near and dear to my heart. I think your allusion was that it's not done well in New Zealand, which is my belief. So do you share the same view? And if so, why?
Yeah. So succession. So I've been around. I think I mentioned I've been in New Zealand for 23 years, and I remember sort of 2005, 2006, ANZ did 3 or 4 years of what they called the privately owned business barometer, so POBI, which is they went out to all these privately owned clients, and they did a whole bunch of it was a whole bunch of questioning, and then they did a big sort of grand reporting. And friends of mine were involved in spearheading. It was a great initiative, but it was entirely self-serving, because generally what they breathlessly said year on year is there's a massive succession planning issue in New Zealand, and we all, as M&A lawyers, we said, yes, there is. That's a great, what a great finding, and people need to sell their businesses, and then really all that's happened over the last 15, 20 years is that the owners have got sort of 15, 20 years older,
Yeah.
right? And it's a really interesting, we talk about it a lot. And over the years, I've been involved in succession planning workshops. And, we've stopped using the word succession planning because that pisses off the owners. They don't like to hear that. They don't like to hear about exits, right? Because they're not in the business of exits. So, we have to be very careful around the words that get used. But you're right. It's not particularly done well. Yes, of course, businesses are being sold every year, but as a proportion of the businesses that are owned in this country, the succession planning is abysmal. And a really quite sad statistic is over the last 2 or 3 years, more and more deals, essentially health deals, where mom or dad are too ill to run the company, and the kids are not interested, and that's very sad. I don't know what the answer is. That people have kind of lost their careers over thinking they were going to be the specialist that could help do that dynamic. I think I've come across quite a few people that can help, that do pretty well, but it's a sensitive topic. It involves families. It's the stereotype is the 70-year-old dad that doesn't want to let go, and and sometimes it's just lack of alternatives. I remember having a conversation with a 60-year-old guy saying, "Well, I make $5 million a year clear profit from my business. I I'm about to get on the plane to go and play elephant polo with the All Blacks. I've got my batch up at Omaha with a ham cutter, like a restaurant grade ham cutter, hamon cutter in my kitchen. I've got a house in Remmers, and I'm, like, why do I need to change? Like, what am I going to replace that with? What kind of put the money in from selling my company that can give me that return? And so there are, there are all sorts of issues with it, but I agree with you. It's a massive problem. And, I think it's going to result in a lot of businesses being quite directionless eventually, because because one of the key problems is that by not selling your business, more often than not, you stay in it.
Yes.
And you don't replace yourself.
And to
And
the
then
detriment of the business at some
keel over.
stage. Yeah, I agree. I was in Kathmandu a couple of years ago and moved around some.
The store across the road, or the country?
The country, yeah.
The city. I should say.
Exactly, yes,
Yeah.
in Nepal, that's right. So easy confusion. So I moved around some of the business circles that were there through Entrepreneurs Organisation, and by day 2, it was really clear to me that they approached the notion of succession planning just fundamentally different from what we do in New Zealand. And it's that the children are expected to go into the family business.
Yeah.
That is just a stated expectation from a young age. And for some of them, they relish it and they love it and they look forward to it. And for others,
It's a duty.
It's a duty and it's not a great part of their life. I think the smarter people kind of go, our expectation of you is to do it for 10 years, and we're going to encourage you into a space that we might have a shortcoming in: commercial skills, study as a lawyer, research and development, go and become an engineer, advisory, investment banker, whatever it might be. So you might work outside of the family business for a couple of years to gather those skills, but then bring them back in, because at the end of my life, if I'm the patriarch that's running the business, you are going to have the responsibility, the ownership, and the rewards of this company as well. And so, put that aside, we don't do that well at all in New Zealand. I know of some companies that are named such and such and sons, and there's no son in the business, right? So it's ironic, because maybe that was the way that was founded by the grandfather, but then didn't end up kind of being the case subsequent to that. I think it's a number of different things that happen. There's no kind of one culprit of it being done poorly. It starts with preparedness of the founder to actually hand on the reins in some way, shape or form. And if they have the desire to do it, then they will make it happen. And, I almost open the book by saying that you will exit this company one day. It's whether it will be by design or default, because you may die at the helm. That's the absolute worst case scenario. Or you may get kind of wheeled out of there and someone has to sell it from under you, which is the second worst case scenario, because we had a dreadful exit price for that thing if that's what happens, because a lot of the business's value will be likely tied up with you.
Yeah.
If you feel like the business can't run without you being there. And then you kind of step your way all the way back to the most ideal scenario, which is that you go through succession planning, you systemize the business, you have effective people management and incentivization schemes in place. You've got an independence of governance, so you've got the board that's in place. You then replace yourself as the CEO. You might go into an executive role. Hopefully you don't go into any of those things. And then you actually have complete freedom from that business, which is a wonderful business to own. You might decide to turn up once a month for a board meeting. You might give yourself a research and design role. I'm just working with a board that I chair, a $25 million software company, phenomenally successful business. Spent 18 months getting the CEO to appoint a COO, who the intention was to have them step into the CEO role. We had a bunch of measures and incentives in place over the course of that year. It was a 12 to 18 month process. Within 11 months, it was pretty clear to me as the chair of the board, like, he's ready. Like, we're just deferring this for the sake of it. Let's do this now. And so we've just did it literally yesterday. I was speaking to the CEO, and life is good. Life is good. He's got this great business. He's put himself into a head of innovation role. He didn't like being the CEO. He's a software developer by trade. And so a great developer, great innovator, founder of the company. And so, by the way, the sole shareholder of the company as well. So really unusual situation. And the maturity and the lack of ego, and that was really important. That's what I said to him at the last board meeting. I have to applaud you for the lack of ego, the ego-less decision that you have made here to put this person now into the CEO role, because it's not just the right thing for the business, it's the right thing for you, and it's the right thing for this person who can grow into it, and also for the board from a clarity of kind of governance perspective. So it's win-win-win. But that took us a reasonable length of time, a couple of
it's
years to
hard
get
work,
to that. Yeah, that's right. It is hard work. And the best thing all round, you've just got to get yourself to that place.
Yeah,
Mm.
yeah, and you're right. I mean, there is no one size fits all, but it is just it just seems to be a problem that's going to get bigger every year
Yeah, I agree.
as the year passes.
And another statement that I have, which is that the best time to think about your exit plan is the day that you start the company.
Yeah.
The second best time is today,
Yeah, that's right.
because you've either thought about it or you haven't.
Yeah.
So
Yeah.
speaking of today and looking ahead to the 12 months ahead, Neil, so predictions for M&A in New Zealand this year.
Yeah, so I think we're cautiously optimistic about activity, and certainly we're sitting here on the 2nd of February, I think it is. January was pretty busy. We've got a few deals already started. So if you look at the kind of cadence of New Zealand M&A landscape, Christmas is obviously a big deal. People try to get deals done by Christmas. Generally, in January, we're finishing off the ones that didn't get over the line with Christmas. But we've got deals that we've been instructed on are starting in January. That's quite unusual. That's quite a good indicator for activity through the year. So in terms of themes, I think we'll see an increase in activity or a continued increase in activity. I don't think it's all good. We've obviously still got some pretty major global unpredictability. Mr. Trump, what the hell is going to do next, sort of thing, and that definitely will temper investment, I think, potentially, depending what happens. We've also got an election.
Yeah.
So election. So my 9 years of doing this M&A forecast, I guess we've had 3 elections, or we're about to have our 3rd election. And so we used to think, well, the people won't do deals in the lead up to an election because of the unpredictability they'll want to see. I actually don't think that's the case anymore because just because of the election. I think in particular, if you look at, again, our stat there is where 2/3 of the deals last year were international buyers. International buyers don't really see the difference between labor and national. They, compared to somewhere like the US, right?
Yeah.
They just see a stable economy, a few settings here. I mean, depending on the industry, clearly there's some settings that you prefer one flavor or the
Yes.
other, but by and large, it's the same. What this election, though, I think, in terms of increase in activity, a little bit longer term, is an interesting one because nationals sort of seems to be signaling asset sales.
Yeah.
So that is actually quite a that there's quite a bit of distinction there, because clearly I don't think Labour is interested in that. So that there's a little bit of stuff around that, but also at the local government level, this kind of rates rise cap. We think this idea of a rate rise cap will create deals because councils are going to have to find ways to fund, right? And in fact, I think yesterday, listening to the news, I think Christchurch Council's already started talking about possibly divesting 1 or 2 of its assets, right, to do exactly that. So that's that. So that election's interesting. Whether there is a pause on activity because of the election, I don't think there will be. One of the things we do see, however, is with overseas investment regulations, with the need to get consent for certain overseas investments, there tends to be a window in an election year. So anything controversial that needs to go to a minister for approval, much later than, say, 2-3 months out from the election, is very unlikely to get you an answer. They'll just sit on it because, there's going to be a bunch of voters who will be annoyed with you whatever you do with that. So we tend to sort of go, well, if there's an election in November, then you kind of need to get your OIO application, if you need one, in by August, or there's going to be a bit of a pause. So that might push some deal timeframes out.
Interesting.
Right, for deals that need, but not all deals need OIO. They're just some of the bigger ones. I think we will continue to see one-on-one deals rather than auction processes, although I think that auction process will get a bit more prevalent as the year progresses. But I think at the moment what we're seeing is still, corporate carve-outs, one-on-one deals, but just a bit more activity, a bit more impetus, a bit more energy around those deals. You've already mentioned it. I think distress. I think we'll see a bit more of that.
Yeah.
And I think the other influence this year is we've got some quite big regulatory change, which is unusual in the M&A space, which will just cause a little bit. I mean, some of it's good, some of it's bad. The good stuff, OIO, is going to become a lot easier where land is involved. So at the moment, there are essentially two triggers for a requirement to get OIO. One is a land-based sort of sensitive land type of test, which is the one that's always in the papers. It's very hard. You have to prove benefits to New Zealand. It's a privilege to invest in New Zealand land, et cetera, et cetera. And a lot of deals get affected by that because it includes things like leasing land or businesses that own land. The kind of big deal test, the significant asset test, which is the $100 million plus, is actually not that hard. It's a responsible investor test. I'm being a bit flippant, but they Google you and you have to have a business plan and you're good for the money and you're not part of the Osama bin Laden family. You're probably okay, right? They're going to move the property test to much more aligned with the significant business assets test. So essentially, they're changing the whole rhetoric. And so if you listen to the government, they talk about, it's no longer we're not saying it's a privilege to invest. We're saying it's great for you to invest unless there's a good reason for you not to.
Right.
So it's slightly different. And that kind of sentiment's really important. One of my partners was up in Canada last year visiting the big Canadian pension funds, and they just whinged and whinged and whinged about our OIO settings. And actually most of it's perception, because we almost always get these deals through one way or the other. But when you start using that different language, I think you create more get more positivity towards New Zealand.
Yeah, got it.
So that's good. On the bad side or the harder side, the Competition Commission is bringing a whole bunch of changes through into our competition laws. Some of it is going to make give them more powers essentially, and bring more deals into the remit, if you like, of the Commerce Commission. And probably just to pick one of, there's a few changes, but to pick one of them, there's now a creeping provision, which is come into Australia already and is looking like it's going to come in here. And that's quite a thought. So without being too technical, a deal in New Zealand is legal or illegal. It's illegal if it substantially lessens competition. So what you do is you look at my business today, and we look at the thing that you're going to sell me, and if that deal is going to substantially lessen competition, then it's illegal, right? Unless I get clearance. Right?
Okay.
Now we're saying, if this deal that we're going to do today, plus all the deals I've done in the last 3 years, substantially lessens competition, then we've got a problem.
Right.
And so that's like a creep provision. And what that means is that private equity has to start thinking about OIO pretty much for the first time.
Yeah, got it.
Because if I have a big platform asset that's got a third of the market, and I buy a little player over here, I'm not moving the dial on my overall position.
Yes.
Right? But if I've got to that position by doing 10 of those deals in the last 3 years, maybe I have. And so we're going to have to start. Assessing the more and more deals, and then probably going and looking for more and more clearances as a result. So there's a bit of a headwind around that stuff.
Yeah, got it. Okay, interesting. Look forward to having you on the show next year to talk about how those things have all played out. So there's a report that's available. Is it to the website, or is it?
Yes. So our M&A forecast you can get on our website.
Yeah, great. It'll be out by the time this episode comes to air. So go to the Minters website and download it. Neil, as always, very grateful for you to come on the show. Insightful and some really informative things about what's going on in the market. So thank you so much.
Thank you very much.
Pleasure. Thanks for listening to the show. If you've enjoyed it, and if you've gotten this far, you definitely have, then I reckon you should go and check out a copy of my book. It's available on my website or Amazon.com. There's an Audible version as well. And it's a blend of personal insight and experience on what it takes to build and sell a company. It's not a how-to guide. You can go to ChatGPT for that. I've had some wonderful unsolicited feedback from people, but I did ask some folk for it, and here is one of the bits of feedback that has come from one of the early readers. Josh has created something rare, a guide that's both deeply practical and genuinely wise. His writing is punchy, clear, and feels like sitting across the table from someone who's been through it all and knows exactly what you need to hear. This is the resource every founder needs when facing the biggest decision of their professional life. Honest, actionable, and completely grounded in reality. That's from Susie McAlpine, who is herself a best-selling author and a speaker and business advisor. Please go check out a copy available on the website. Thanks for listening.